Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TS Lines Limited annual report. TS Lines Limited offers a diverse range of services to various clients across the globe. The company provides shipping container and related services in multiple countries, including Hong Kong, mainland China, Taiwan, the Philippines, Japan, Australia, Thailand, India, and internationally. The company's services include vessel chartering and shipping agency services, which cater to different types of customers such as freight forwarders, other container shipping companies, and BCO, beneficial cargo owner, customers. These BCO customers are typically small and medium-sized businesses that manufacture consumer, primary, and mechanical products. TS Lines Limited operates a fleet of owned vessels and chartered vessels to provide these services, ensuring efficient and reliable transportation of goods across the globe. With its extensive network and expertise in shipping container services, TS Lines Limited has established itself as a reputable player in the industry since its incorporation in 2001. TS Lines Limited market capitalization of $15 billion is materially smaller than most of its industry peers of roughly $58 billion. TS Lines Limited trades at a lower price-to-earnings ratio of 4 times and a higher price-to-book ratio of 0.98 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced even though it is trading at a higher price-to-book value than it peers. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap, and if it would be better to be investing in it peers than TS Lines Limited itself. The balance sheet appears very conservative, with liabilities representing only 15% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 9.43%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline are largely influenced by market dynamics and economic factors. On the one hand, a decrease in global freight rates, growing supply of shipping capacity, and increased competition in the Asia-Pacific market have contributed to revenue decline. Specifically, freight rate adjustments in certain markets such as Asia-Indian subcontinent, Asia-Oceania, and North Asia-Southeast Asia have resulted in significant declines. On the other hand, revenue growth has been driven by an increase in charter hire revenue from vessels, which rose by 29.3%. Additionally, other container shipping-related services such as slotting revenue, demurrage, and detention income have also seen growth. Furthermore, freight rate adjustments in certain markets like Greater China and Greater China North Asia have resulted in significant increases. These factors highlight the importance of market conditions and economic trends in shaping revenue outcomes for companies operating in the shipping industry. The net income of the company experienced fluctuations over the given period. Initially, it decreased by $37,315, indicating a decline in revenue or increase in expenses. However, this trend was reversed with an increase of 24% from $92,735 to $114,507. Despite this growth, net income still declined by 19.5% and $37 million at different points. The profit margins also underwent changes during the period. The gross profit margin decreased from 23.4% to 19.7%, while the operating profit margin dropped from 27.3% to 25.6%. However, there was an increase in charter hire revenue and net foreign exchange gain that offset the rise in staff costs and other expenses. Despite this, the overall trend showed a decline in profit margins from 23.5% to 19.7%. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. One key indicator of this trend is the generation of positive operating cash flow. According to the latest figures, the company has achieved an impressive operating cash flow of $90.5 million, page 19. This development suggests that the company's business model is becoming increasingly efficient and profitable, enabling it to generate substantial cash from its daily operations. This achievement is a testament to the company's ability to manage its resources effectively and optimize its financial performance. The positive operating cash flow not only provides the company with the necessary funds to invest in growth initiatives, but also enhances its liquidity position, allowing it to navigate any potential challenges or uncertainties in the market. Overall, the generation of $90.5 million in positive operating cash flow is a significant milestone for the company, reflecting its growing financial strength and resilience. Management is expressing a positive outlook for the company's future. They plan to continue optimizing their route network and revenue structure to improve efficiency and profitability. Additionally, new investments will enhance operational flexibility and economies of scale while ensuring environmental and regulatory compliance. The company aims to utilize its remaining proceeds by the end of 2026, but acknowledges that market conditions may impact this timeline. Overall, management statements suggest a focus on long-term growth and sustainability, with a commitment to adapting to changing market conditions. The company's commitment to its shareholders is evident in its dividend policy. In line with this, the company has a history of paying dividends to its equity shareholders. Specifically, it declared and paid an interim dividend, as well as paid out dividends from the previous financial year during the current period. This demonstrates the company's dedication to returning value to its investors through regular dividend payments. Concerns about inventory buildup or supply chain disruption are indeed present. The escalating tensions in the Middle East and security concerns over the Red Sea shipping lanes pose a significant threat to global shipping supply and logistics efficiency. This is evident from the increased voyage distance due to diversion around the Cape of Good Hope, which has led to higher fuel costs exerting impacts on market supply. Furthermore, the pressure on supply side is gradually emerging, leading to a fluctuating trend of freight rates. Shortening supply chains are becoming increasingly definite, and geopolitical and policy factors are influencing market supply and demand. Heightened security risks in key shipping routes, such as the Strait of Hormuz and the Red Sea, also pose a threat. Additionally, shifts in trade policies and tariff measures by major economies may affect global supply chains and cargo flows. Volatile energy prices are boosting transportation costs, further exacerbating the situation. These factors collectively contribute to concerns about inventory buildup or supply chain disruption. That concludes the financial summary for TS Lines Limited. Feel free to comment below, and I will be happy to answer them when possible.